Hello, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to another sample trade video in a series I've been doing now for several months with trades taking from one of my option portfolios that I'm sharing with you, the BCI community. This is a real-life example with Celestica Inc., a stock listed on the New York Stock Exchange under the ticker symbol CLS. Now, I initiated this trade on June 16th, 2025, Monday, and it expires on June 20th, 2025, Friday. So it's a 5-day trade. Now, today, the day that I'm creating this video, is Thursday, June 19th. Well, today the stock market is closed in recognition of the Juneteenth Independence Day holiday. So even though I'm framing this as a 5-day trade, it's really 4 trading days. So this is Thursday morning, June 19th. And once again, this is a defensive cash secured put trade. And all the trades that you see in these sample trade videos are taken from one of the premium member reports that we provide to our premium members. This is taken from our stock report, but you'll also see videos where I'll take a security from our exchange traded fund report, or perhaps from our blue chip or Dow 30 report. Once again, this one is from our premium member stock report. So why did I choose Celestica as one of my securities? Now, you'll notice that in the presentation, you'll see that I took a 200 share contract obligation. Now, I sell between 100 and 150 contracts every month. So this one is just 2 of those contracts. Now, here's why Celestica was one of the securities that I used this month. Well, first off, you're seeing like a little snippet of our premium member stock report. Now, the report in its entirety is 9 pages long. You're seeing just a small portion of that. So you could see on the left of the screenshot that Celestica is listed in bold. That means that all of the technical indicators that we use at BCI were all bullish. Okay, now you'll see here that Celestica was listed as number 6 on the IBD 50, meaning that it is a strong elite performer from both fundamental and technical perspectives. Now, Celestica is in the electronics industry segment, which at the time I executed the trade was ranked B and was ranked B the week before as well. Now, the mean analyst rating, or MAR, was 1.25, which is outstanding because 1 is the very highest and 5 would be the lowest. So this is excellent. You can also see the on-balance volume. It has an up arrow, so that's trending upward, which is a bullish signal. That means more money is coming into the stock on up days than on down days. Now, if we can move over here to the at-the-money implied volatility, you can see it's 54.5%. Well, that's quite robust. Just to give you an idea, it's about 3.5 times that of the S&P 500 at the time the trade was executed. So a robust implied volatility means that we could still craft our trades defensively and end up with significant annualized returns. Now, option liquidity was adequate, and the next earnings report, 7/23, doesn't affect the current expiration. So earnings reports were not a factor with this trade. Now, I want to show you first a 1-month price chart of Celestica, where you see this red arrow here and the orange line at the top. That represents the 1-month price performance of Celestica. And compared to the S&P 500, the blue line below it, you could see that Celestica was impressively outperforming the S&P, or the market, over the past 1 month. Now, here's the technical chart I alluded to earlier. Remember, all the signals were bullish. Well, number 1 is the trend, which are the exponential moving averages, the 20-day blue line, the 100-day red line. We always want the more recent prices blue above the longer term prices. You could see that the price bars are at or above the 20-day EMA. That's bullish. And you could see where this circle is at the top. You could see that crossover, that bullish short-term crossover where the 20-day crossed over the 100. So this is powerfully bullish in terms of trend. Now, the green arrow over here shows that the MACD histogram is slightly above the zero line, which again is a bullish signal. The purple arrow is the stochastic oscillator, which is a momentum indicator, and that is ascending at the time the trade was executed, another bullish signal. Now, are these factors significant? Well, yep, the volume is holding up well, so that means that all of the signals above it are significant. So that's why Celestica was in bold on the report, and one of the reasons why I selected it for my option portfolios this particular week. Now let's take a look at the put calculations for this defensive trade. You'll notice at the time that I executed the trade, Celestica was priced at 132.49. I went deep out of the money with a 124 strike, which generated 58 cents or $58 per contract. Well, is that significant? Let's find out. The Trade Management Calculator, or TMC, tells us that if taken through expiration, it's a 5-day trade. Now, of course, it's 4 trading days because today, Thursday, the market is closed. You'll notice with this broken red arrow over here that the break-even price point is lowered substantially from 132.49 to a break-even price of 123.42. That's what makes this a defensive trade. But how much money are we going to make? Well, if we take that 58 cents and divide it by our cost basis, which is the put strike minus the put premium, it comes out to a 0.47% 5-day return, which annualizes out to a very significant, I think, 34.31%. Now, if the price of Celestica moves from 132.49 to below the 124 strike and shares are put to me at 123.42, I will have purchased it at a discount of 6.85%, you see in the purple cell here, compared to the price when the trade was first executed, 132.49. So those are the two outcomes, a 34% annualized return or purchasing the shares at a discount of almost 7%. Now this screenshot is showing you the broker confirmation of my put trade. You could see here that it was filled at 58 cents, and that generated $116 less some minuscule trading commissions into my cash account. Now, let's take a look again, just go through this now. We initially generated $116. The amount of cash required to secure that put, the put strike minus the put premium times 200 shares, was $24,684. That means our 5-day unexercised return, as I said, 0.47%, 34.31% annualized with downside protection of 6.85%. Now, guess what? The price of Celestica went up. On Wednesday morning, it was priced at 138.91. That was yesterday on June 18th in the morning. So what happened? I was able to buy back that put at 15 cents. I sold it at 58, but I was able to buy it back at 15 cents and sell the 132. I rolled it up. I rolled the put strike up from 124 to 132, and that generated 55 cents. So I made an additional 40 cents per share or $80 for the 2 contracts into my portfolio. And you'll notice that the put strike was still significantly out of the money, 132 compared to that current market value of 138.91. This shows a screenshot of my brokerage confirmation of buying back the 124 put at 15 cents and selling the 132 put rolling up at 55 cents. And that accounts for the additional $80. Now, as of market close yesterday on Wednesday, 6/18, CLS closed at 136.25. This represented an increase of $3.76 above the price when I initiated these trades. It was also $4.25 above the original put strike. Now, it was $5.33 above the new break-even price point, which is 130.92. So rolling up exit strategy was executed to generate an additional $80. Now, tomorrow is the last trading day of this contract, Friday. Now, remember, Celestica was trading at 136.25 at market close on Wednesday. As long as it stays above 132 tomorrow, we will have a final realized 0.85%, 60.22% annualized return. It will be realized. Now, I just want to review with you what this is all about. I want to point out that we can get significant returns with a 5-day defensive cash secured put trade. This is a perfect example of that. Option trades can be crafted to align with any market condition and any personal risk tolerance. In this case, I am a little bit concerned about the uncertainty in the market, so I've been crafting most of my trades defensively. Now, in this particular case, you saw for yourself that a significant initial 5-day return was captured and is currently in a very reasonable position for a successful trade. Celestica would have to drop quite a bit on tomorrow and Friday for this not to be successful. It's possible. Now, what happens? Do I have a plan in place if that happens? What do I do? Am I going to buy back the option so the shares aren't put to me? Or am I going to accept the shares and then write a covered call, a strategy known as the PCP or put call put strategy, frequently called the wheel strategy outside of the BCI community? I will make a final call on that tomorrow, but my inclination today would be to accept having the put exercised and the shares put to me, and then writing a covered call because this is such an elite performing security. Again, I'll make my final call tomorrow if necessary. In other words, if the price drops below that last 132 strike. So, folks, that ends this sample trade video using Celestica Inc., a 5-day defensive cash secured put trade. Ladies and gentlemen, I hope you enjoyed this presentation, but most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.